My recent video on DBS, OCBC, and UOB generated some discussion in my blog. Reader says to AK. Thanks for this post. The banks are slightly higher on hopes for an extended net interest margin honeymoon period. This is after the Fed officials once again started talking about need for higher rates in the last few days. The bank stocks are, no doubt, attractive at this level. Of the three Singapore banks, talking of Common Equity Tier 1, OCBC has the highest. I am worried that OCBC might end up buying a Chinese or Indonesian bank rather than reward us shareholders with share buybacks and higher dividends. DBS, after the recent fiasco plus India expansion, has lower Common Equity Tier 1 capital ratio and, hopefully, all they need is to work more on wealth management. Their acquisitions of other banks' wealth management arms should pay off if markets go higher, and this will help us all as the management might pay higher dividends. As for UOB, all hinges on their execution of the Citibank deal. UOB might outperform if this goes well and Southeast Asian economies recover. The three banks are my biggest holdings together, and I have strived to hold almost equal proportion of these three so far. Once the Fed pivots and the rates burden goes, still if the economy holds up, these banks will continue to do well. AK says to reader. Since I shared my strategy to reallocate in an environment of high inflation and rapidly rising interest rate, my already significant investments in the banks have become even bigger. So, like you, they are collectively my largest investment in my portfolio. An extended expanding net interest margin honeymoon is not a bad thing, although it could cause some pain for the real estate investment trusts in the portfolio. We can only hope that OCBC stays prudent and not overpay for any acquisition. As for DBS, I don't understand why they had so many disruptions to their internet banking services when its smaller peers didn't. I can only hope it does not happen again. The disruptions aren't something crippling, but they are high-profile negatives. For sure, the projection by Piyush Gupta for DBS to grow its earnings to $10 billion in the medium term is reassuring. This is a rather short time frame of only 3 to 5 years. Analysts are only projecting a growth to some $9.6 billion. At a 50% payout ratio, it would already translate to a dividend per share of $1.86, which is higher than the current guidance of $1.68 per share provided by DBS. It would be sweet if DBS exceeds already positive expectations. During Evening with AK and Friends 2023, I said UOB could lead the Singapore banks this year in terms of earnings growth, as it has completed the integration of Citibank's consumer business it bought in 3 out of 4 Southeast Asian countries. They will contribute to UOB's full-year earnings this year. There are still many wild cards out there, but the possibility of a US recession doesn't seem to be one anymore because everything points to it happening within the year. This recession in the USA has become the most anticipated recession ever. So, when it happens, Mr. Market might not even bat an eyelid. I have said many times that Singapore's banks are well capitalized and well managed. Recently, I also said that they are well regulated. If Mr. Market should go into a depression, which has happened many times in the past before, I hope I would have the resources to buy more. So, while I am staying invested in Singapore's banks, I am also refilling my war chest. End of conversation. I remind myself that there is a lot of waiting when investing for income. It isn't just about waiting for dividends. It is also about waiting for opportunities to put more money to work. Investing for income allows us to be paid while we wait. If AK can do it, so can you.